So I think we're going to pick up the conversation. As we mentioned earlier, won't do thorough intros, but suffice to say, we've got a great panel with some really strong perspectives. I think what we're going to take the conversation from that really great overview of the science that Catherine gave and move to how's the business community, how's the investment community thinking about those risks and opportunities in the work that they do. So I'd like to start with a question for you all about how your respective organizations think about climate change from both a risk and an opportunity perspective. Can you start with you, Ron?
So yeah, I'd be happy to start. So at Lazard, basically, I'm probably the only non-specialist on the stage. So I'm responsible for running a portion of our global investment platform, including U.S. equities, multi-asset, and part of our global equities business. And the approach we've taken is an integrated approach. And so what we've said to every analyst covering securities on the equity or the fixed income side is we want you to quantify what the potential costs are from environmental, social, and governance factors, and how we should think about how those affect your target valuation for a company. So effectively, there are a range of different ways to approach investing in terms of environment, social, and governance, or ESG. So there are a range of approaches people take. Some of our clients basically have exclusion lists where they say, I don't want to touch any company in fossil fuels. Or more likely in Scandinavia, no one who produces cluster bombs. So people have restriction lists. We're not taking that approach. I think what we're looking at it is just part of being a fiduciary. I mean, if I didn't say the letters ESG, and I said to you, when you examine a company and you think about the valuation of a company, and I said, it's pretty obvious you should think about the quality of management, and you would think about management incentives and their compensation structure, you would say, well, of course I would do that. Well, that's a big part of G, right? If I said to you, if General Electric is going to dump PCBs in the Hudson River next to New York City, and someday pay billions of dollars to clean it up, should you take that into account in your valuation? You would say, well, of course I do, because I'm thinking about the future cash flows of the company. Well, that's E, right? Social issues. If you think about recent issues with Facebook and your privacy, if you think about Wells Fargo creating fake accounts, there are a range of companies, and these are all very logical things we should do as just a course of business. And I think when we look back in 5 or 10 years, we will say it was irresponsible and to some degree incomprehensible that some people would not try to quantify these risk factors and put them into their valuation. So far that is our approach. I would say the biggest challenge of that is data and disclosure. And so one of the questions earlier of what can we do about this and what can business and government do, I mean, part of why I wanted to be here and speak with you guys today is I don't expect that everyone in this room or watching this will become an ESG investor, but if you become the CFO or CEO of a company, you can improve this story by having better disclosure and making it a priority to disclose your carbon emissions, to disclose your practices, and then you can quantify those measures for investors and help us understand where we want to direct capital. And I think that actually, in and of itself, disclosure gives you something to measure, which gives you basically objectives you can create.
Awesome. Thanks. Mark, would you care to add thoughts?
Sure. So first of all, I want to say I'm thrilled to be here, and I'll pause and say kind of thrilled. I grew up in Syracuse, so we'll just start there. Second, I'd like to see a show of hands of how many folks were in the Chris Wedding class on ESG last fall. Mm-hmm. I know you guys were there. So just great to see you finally in person. So we did a call on the phone virtually, and it's so much better to see faces when we interact with our clients, with our folks in the audience. So State Street, what is State Street? First of all, when you think State Street, you possibly think Fearless Girl. That is one aspect of our business, which is the asset management side of State Street. Think 33.1 trillion. Think safekeeper of roughly 12% of the world's tradable assets. So that's our bread and butter. That's State Street. We've been around since 1792. So George Washington was kicking around then. And our first and foremost goal is to be a fiduciary responsible for pension funds, endowments, institutional investor money, safekeeper of assets. We also have the asset management arm, which I touched on. We have a trading arm with the principal trader of foreign exchange, as well as the largest securities lender on the planet. We've got a AA balance sheet, and we have something called risk analytics, and that's where I sit. Long-winded intro to Dan's question, what are the risks and opportunities that State Street faces in this whole space of climate change and ESG? First of all, I would say, what's the risk? Well, we don't have a coal-fired power plant in our basement. But when we think about climate change and risk, I would probably point that one of the biggest risks that State Street has is reputational risk, that we don't look internally to say, what is our own carbon footprint? So I sit on the Executive Corporate Responsibility Committee at State Street, and what we do is we measure our global carbon footprint. Now, as I mentioned, we don't have, you all know what Scope 1, 2, and 3 carbon emissions is? Okay. So Scope 1, we don't have a coal-fired power plant in our basement, so let's just say we don't have Scope 1 emissions. We do have Scope 2 emissions, which are the electric lights, right? So our, let's just say global electricity bill. We're in 30 different countries around the planet. So we measure that, and we also have global business travel. Scope 3 being our supply chain. So on an annual basis, we measure that carbon footprint, and we put together a portfolio of renewable energy credits and carbon offsets to be able to make the following messaging for reputational enhancement, effectively branding of State Street. That our North American electric load is carbon neutral. We LEED certify 3 buildings in Boston. If you've been there, you've seen the big building there, State Street. And our global business travel is carbon net negative. So from a reputational risk perspective, as it relates to climate change and our business risk, I would argue that's how we address that piece. Now, from the opportunity set, I couldn't be more thrilled to be at State Street in the sense that most of my career has been trading. I've been sitting in foreign exchange finance since 1987, so I'm a bit old, and I've been trading markets for a while. And I had an epiphany one year about this whole idea of carbon credits and renewable energy credits basically being the same thing as FX. And so I got into the space back in 2005. I won't bore you with all the details, which I think I bored the class last time on the phone call. But the bottom line was I got to State Street, I said, here's an opportunity. Here's an opportunity to really affect climate change. State Street touches 33.1 trillion or 15% of the world's tradable assets. If we can tap into capital markets and leverage all the disciplines in State Street, which are fivefold. 1, we trade. 2, we safekeep. 3, we manage. 4, we analyze from a research perspective. And 5, we brand. Take those 5 verbs, address that 33 trillion, and provide research and analytics around those portfolios. So my day job right now, as we just talked about, is called ESG Solutions. We're starting with the data, which we'll get into a little more detail. We are building models to identify these things called non-financial risks in portfolios. So who knows about Peabody Coal? So Peabody Coal, right, in 2011, the stock was trading at $1,000 a share. Speed up the clock, if you're still owning the stock last fall, went bankrupt. They ignored this regulatory shift around climate change. They ignored changing their technology from coal to possibly renewable energy infrastructure. And as we touched about, S&G are also relevant. Who knows the company called Facebook, right? $60 billion impact of that portfolio, right? What were they doing to their clients? That's a pretty big impact. And G, who drives a Volkswagen, right? So that's another example. Fraudulent software being put into vehicles. So E, S, and G, we're focusing on E today, but all those are relevant. So my point is, State Street, starting with the data, building these models to identify these risks, and then pointing them to global advisors to invest dollars to diversify away from some of these risks, particularly about low carbon ETFs, alpha funds, et cetera, and also the ability to trade RECs and carbon offsets. So that's the opportunity set from State Street perspective.
Great. Elizabeth?
So I am here representing Terra Alpha Investments. We are a company that invests in publicly traded companies, so big companies. We believe we are investing in the most fundamentally strong businesses over the long term. And when we think about climate risks, what we really try to think about is to bring it down to the ground a little bit more, and we find that to be more practical from an investment perspective. So to think about actually all of the natural systems of the world that are contributing to climate change and are also impacted increasingly severely by climate change. So our systems related to food and agriculture, energy, transportation, retail, all of these sorts of things. This is the way that we think about making investments into companies, is through these sectors, and increasingly they are really dramatically impacted by climate change, and they are what is producing climate change, is sort of it's underpinning our global economies. So what we believe is that if we can identify the most fundamentally strong businesses in terms of using natural resources, we will be invested in the best companies over the longer term. So we want to understand what the companies are that understand their natural resource usage the best and are managing it the best. And the term we use is environmental productivity. Which of these companies is the most environmentally productive? Now, despite certainly there being lots of gaps in the data, and we can talk about that later, there is a lot of data out there. And frankly, most mainstream investors are not using it. And and don't sort of understand the value. We feel like we're using this incredibly valuable information that other investors really haven't identified yet. And so what we're doing as a first cut is we're taking the raw carbon emissions of companies. So out of the possible universe of maybe 6,000 or 7,000 companies of the type that we would invest in the public markets, 2,200 disclose their emissions, but that's 75% of the market cap of the S&P 500. So you can, and it's increased dramatically in the last few years in terms of the companies that are disclosing. So this is the wave of the future. I would say the near-term future. I mean, this is the way that companies are going, is to understand that they need to disclose this. And we believe if they disclose it, they will manage it, and they will understand the impact on their businesses. A number of companies also disclose their waste usage and their water usage. And we look at that very seriously. That's our first cut. We won't invest in companies that we think are not paying attention to that. So we narrow it down to that. We use that as our first cut, and then we go about and we identify which companies are best in class in their sectors in terms of environmental productivity and natural resource usage. And this is really a very key input into a more fundamental traditional investment analysis that we do as we analyze companies over the long term. And I should make another important point. I think that in terms of our perspective on the world is that we are long-term oriented, and that is a blessing that we have. Our investors have given us money to invest on their behalf with the understanding that we will look to the long term. We are not looking to the next 3 months. We are not looking to the end of this year. We believe that if we can take a long-term approach to identifying these best companies, we will outperform the markets. And so we are lucky to have investors that have that perspective. We think that's critical to being able to show that investment performance can be paired with improving environmental productivity and having the right outcome for the climate and for the planet as well.
Great. And Kate?
Thanks so much. It's great to be here. So I'm going to sort of broaden out a little bit from what folks have been talking about. Last night, Matt Arnold was talking about the people in the investment world who do sort of the policy advisory side, and it's sort of a good way to describe what I do. Most of my background's in policy and climate and energy, and in the last few years, I've spent most of my time in more of an advisory role to both companies and investors, and also at the Paulson Institute to Hank Paulson, former Treasury Secretary. So a couple years ago, I was working with Tom Steyer, who at the time was running Farallon Capital, a big hedge fund, and we had a conversation about why is climate change not more of an economic issue in the United States? Why has it become sort of a conversation either about the science or about the policy solution without a real kind of focus on where are the core economics? And this was something in Europe that had happened a few years before that. For those who have read the Stern report from 2006, if you hadn't, you should. Sir Nicholas Stern, who was at the time the head of the Bank of England, wrote a report about the kind of cost benefit of doing something on climate change versus not globally. And Tom and I and some others took a look at that and thought, would that work here? How do we do something similar to shift the conversation? And made a decision that in the United States, the way to shift the conversation really is to start talking about risk. And this is something we've all said a lot today. Here in the US, we have a very business-focused and investor-focused kind of approach to economics. And in that context, our risk conversation is absolutely mainstream. We think about business risk all the time. We think about terrorism risk. We think about extreme weather risk. Anyone who's doing risk evaluation for Goldman or for one of these big firms is doing this on a daily basis, the risk of inflation. So we started taking a look at how to quantify the economic risk of climate change, and that ended up becoming something called the Risky Business Project, which was a project co-chaired by Tom Steyer, Hank Paulson, and Mike Bloomberg, with a number of others on board, including a number of former CEOs. Risky Business took an approach that I've continued to kind of take, and we continue to do this work in a variety of ways, where we looked at, in that first report, we really looked at one of the pieces that Dan talked about earlier of the sort of three big risks: physical risk, transition risk, and then liability risk. Risky Business Project at first took really a physical risk, an approach to the physical risk. We found that companies, CEOs in particular, and investors in large sort of place-based assets, so you think about agriculture, manufacturing, where firms are getting put in place, infrastructure investment. Those are investments today that are multi-decade timeframes. And so people in that situation are thinking every day, actually, about things on a longer-term time scale than we often think that companies and investors do. We found that bringing those physical risks, we particularly focused, I should say, on extreme heat, sea level rise, storm surge, and those risks that were easier to model. Looking at those risks to specific regions of the country and specific sectors, and we looked at commodity, agriculture, energy demand, coastal property, and then labor productivity and health. Bringing those down to like a county level and becoming very granular actually opened a conversation with an entire set of business and investment folks that were not already talking about climate change, and to some extent weren't even talking about ESG. I mean, this was a sort of a conversation that had been very political in the United States, and we worked to open it up to be more of an economic conversation. Followed that up a couple years later with a big report on the opportunity side and on decarbonization. So I bring that up just to say, and this has been followed by the Task Force on Climate-Related Financial Disclosure, which really did a fantastic job of laying out a framework on those risks and starting to move toward the question that I've spent most of my time in the last couple years on, which is how do you actually move this to be more systematized within the corporates and the investor side. I work with the Paulson Institute, thinking about the organizational question Dan asked. It's always hard for me because I sort of work across a lot of organizations, but one of my major roles is senior advisor at the Paulson Institute. We have a US-China CEO Council of 20 CEOs in both countries, and we work with them to have this exact conversation. How do you take this seemingly sort of vague concept of the existential risk of climate change and bring it into an operational focus? How do you start thinking about what does this look like to my supply chain? Where am I investing today in a way that may not be resilient? Which one of these assets I'm investing in might become, I hesitate to say stranded. I think Matt Arnold made a good point last night about stranded assets being sort of a gimmick, but where am I investing today in assets that might just lose value because of impacts that we actually can model in terms particularly of storm surge and of extreme heat? Where am I investing in workers where labor productivity is going to go way down because of heat impacts? Where am I investing in infrastructure that's not as hardened as it should be? And also this question of companies of how am I ignoring the signs? So a big part of what I do is work with companies and investors to look at what the global context is on policy and to say, there are 40 countries and 20 jurisdictions today that have a price on carbon of some kind. Where are those prices moving? Where are they now? Where are they increasing? How is that affecting how we do business across these jurisdictions? What regulations are in place that are essentially a shadow price on carbon? In California, we have a low carbon fuel standard, which is essentially a shadow price on carbon for fuels at a very high level. This new 45Q thing in the tax bill, which you just heard about from Catherine, that's a shadow price on, that provides a shadow price for removing carbon. So where are those things happening? How should companies pay attention to them? It's an incredibly interesting field. The last thing I'll say is I really do, from the time we started Risky Business, which was 2013 to today, there has been a sea change in this field. We have moved to a place where, as you said, Dan, the World Economic Forum put the 5 environmental risks in its top quadrant for both likelihood and severity for the first time. That is huge. Over terrorism risk, over cybersecurity. That is a very, very big deal. That's a mainstream report making that case. And then the Larry Fink letter, which if you haven't read, you should read, from BlackRock, making the case that companies need to start incorporating these kinds of long-term risk conversations as a matter of course in order to be doing business sustainably, but also just responsibly. I think that move to the mainstream is really, really critical. So that's a lot of what I'm doing.
Great, thanks. I think you all, to some degree, began to touch on this, but do want to ask it explicitly, kind of the flip side of that question. So we were just talking about how your organizations are looking at climate risk and opportunity. And the other side of that, for the folks in the asset management investment side, but also Kate as well in terms of the companies you're engaging with, what are you looking to those companies? What types of proactive measures or behaviors or perspectives are you looking to see to say that these companies are beginning to look at this from both the physical climate impacts as well as transition? And then also, a second part of that, if you can think of companies or sectors, if you don't want to name names, where there are examples of getting out ahead and doing that well, or maybe perhaps not being as proactive as they could. And maybe we'll kind of go in reverse order there and start with Kate.
In some ways, I'm the least qualified to answer this just because you're all working every day with companies. I do have somewhat of a view of what some of these folks are doing. Where is it actually changing? I think we're seeing more of a move toward disclosure, which is, I would just agree, disclosure is just critically important. I mean, it's important for investors to know what's actually going on. It's important for companies to be held to that standard. And companies that are doing disclosure and are best in class should be getting value out of doing that, reputational value, and in some cases just reduce risk. Some of the places that I've seen actual change happen. So on the reducing risk side, Tyson Foods is an interesting example, actually. I like them because they're not an example on sea level rise, which a lot of people talk about, but more on extreme heat. Tyson obviously does a lot of chicken operations. That's what they do. And chickens, the things you learn from these projects are fascinating. What I've learned about chickens is that they don't cool down very easily. So you can't take, like a hog, you can spray periodically in a facility and they get cooled down by getting sprayed. Chickens, if you spray them down, just are wet chickens. They don't, it's not a good idea, actually. It turns out they start to be moldy in wet chickens if you spray them down. Not a good idea to spray chickens. So you actually have to air condition chickens. And Tyson had a lot of facilities in the Southeast, and that's just becoming more and more untenable. The air conditioning costs are going up and up because we are seeing just heat impacts rising more and more days over 95 degrees, months over 95 degrees in some parts of the United States. So they're starting to move some of those operations north instead of spending as much as they were on air conditioning. That's an interesting thing because it's an operational change that's being made because of these impacts in real time. The agricultural sector is sort of at the leading edge of that. Lots of other examples out there, but I'll let these guys go to who they're working with.
Yeah, so I mean, I think starting with the emissions, that's sort of an area where this is the wave of the future. So my colleague Tim Dunn, who founded the firm, he sometimes says, that companies didn't used to disclose their revenue. There was a time when companies didn't disclose revenue, right? But then we all recognized, especially the owners of companies recognized they need to know this information, and emissions is going to be the same, right? Owners of the company, the investors, and other stakeholders, frankly, need to understand what the risks are associated with emissions for companies. So getting beyond Scope 1 and Scope 2 out into companies understanding their supply chains, that's something that we see, and we would like to help companies be able to do that, but we see some real leading companies doing that, and I think that's critical to understanding an entire picture of a company, and also getting into markets that are not the developed Western economies where there is a lot more disclosure and understanding of emission risks. So we also talk to companies about water a lot, and not just sort of total water usage, but where the water usage is compared to where the physical water aqueducts are and basins are, and mapping that. And so it's not just a sort of net water usage, water replenished or water saved. It has to actually, this is actually a very localized problem, unlike emissions. So it's trying to work with companies around that. And waste usage is another big one for us. One thing that I think is important to us with our strategy is that we really want to engage in companies in a productive, proactive way. I mean, we're certainly willing to join with other investors and sort of being more adversarial and going after supporting shareholder resolutions that force companies to have greater disclosure and everything like this. But what we've actually found is that there are a number of companies who are taking proactive steps, and they want to be recognized as the leaders. And they're frankly excited when an investor recognizes them and says, this was a really great report that you did on your water usage or something like that. So yeah, that's what it is.
So from the State Street Global Advisors perspective, I've mentioned the Fearless Girl before. We use proxy voting. That's a good example. I'm using this as an analogy for gender diversity on boards, right? Take the same thing with climate. So we're looking at our client base and through proxy voting and shareholder resolutions, using ESG data to say, what are you guys doing around your sustainability risk profile? What's the exposure of your portfolio? Do we want to stay invested in you through the ETFs we're building or not? So that's that piece. Two companies I give a shout out for that I think are doing a great job. First and foremost, that would be the poster child of climate change, and someone I think very, very highly of is Paul Pullman, CEO of Unilever, $73 billion in assets. And he's basically made a resolution saying, and I'll read it, vision to fully decouple its growth from the environmental footprint implementation of sustainably long-term business strategy and using that as a way to slow down climate change. He just resigned from the World Business Council on Sustainable Development, so a real rock star in this space. So have a chance, Google him. I would highly recommend that. The second one I'd give a shout out to is Mats Andersson, the fourth largest Swedish pension fund, AP4. They diversified, I think it was 500 million in their fossil fuel investments. Yeah. The new CEO now is Nicholas Ekbal, who's taking on that mandate. So again, Unilever, AP4 doing a great job around climate change.
Great.
I'd say at Lazard, our real focus is on sustainability of returns. And so yet again, the coincidence of words, but we're trying to think about, I mean, again, anyone investing in any equity or bond is thinking about what are the cash flows going to be in the future? How sustainable are those cash flows? And if you have practices where you basically are operating a mine in Chile and you don't have water, how sustainable is your mining profitability, right? If you're thinking about fuel, how are you using fuel? So our focus is consistently on sustainability. And I would say what we're doing is very similar in some way to what Mark mentioned for State Street, is using our proxies, obviously. I mean, we're voting every proxy for our clients in their own fiduciary interest, taking into account that sustainability factor. We've also, I would say in the last 5-10 years, increased our direct engagement with companies a lot more. And so I think many investors underappreciate what a difference it makes when you're sitting with the CEO talking about the strategy of the company, talking about profitability, and you address the sustainability of their business practices, or you address diversity on their board. And so we've actually taken a much more proactive approach there. And I would say, this is something outside of the US, it's a given, it's expected. I think it was made a comment earlier about how when you think about climate change, it's only really debated in the US, Australia, and Canada to some degree. Globally, everywhere else, it's a given, it is factual, it is science. And so, I think this is something we're seeing more. In terms of shout outs, let's go into the deepest, darkest part of the universe in terms of climate change, fossil fuel companies. Yep. And what I think is really impressive is the European energy companies in many cases are actually doing investor days focused on ESG and trying to basically highlight what they're doing to change. Statoil recently changed their name to Equinor. They said the last 50 years was about fossil fuels. The next 50 years are different. And Equinor, by the way, is a created term embedding equality, Norwegian values, et cetera. But one thing that's really impressive is even how they power their offshore rigs, they're actually using hydropower. Yeah. And so, you see companies like that outside of the US really being proactive, recognizing the sustainability of their old business practices is not only in question, it's pretty clear what the destination is going to be, and they're trying to figure out how to get there faster and remodel their businesses to something that can be profitable in the future. Great point. So, I think there are a lot of good opportunities. By the way, one other thing, I tend to think about ESG and climate change as a risk-reducing factor, and there's been an interesting perception that as an investor, you can choose returns or you can choose to be a good person, right? You can choose to have an impact, but you don't get as much money out of that. I think that's absolutely wrong. Yep. I think investing with a mind of sustainability is an alpha signal. And it's partly from reducing risk, but it's also over time, as we do have more transparent pricing of some of the externalities companies have imposed on the economy and on society, this will be priced for you and it will actually lead to alpha. And so I think there is an alpha signal in investing properly based on long-term trends. And I would also say, I think there are opportunities in the companies that will help us as a society adapt to the changing world. So we shouldn't just think of the negative. I think there's a lot of opportunity to make money from addressing the climate change that we see coming.
I would reiterate what Ron said. That's the secret, guys. Don't tell anybody. You can make a lot of money in this space and actually save the planet too. That's why it's so cool, and I think that's why we're all here. Right. So.
Great, and so we're going to go this way, so prepare yourselves. But wanted to pick up the conversation that Shuman and Matt had last night about carbon asset risk and stranded assets, and maybe get away from the kind of more charged stranded asset risk part, but really talk about carbon asset risk. And we were talking about the task force for climate-related financial disclosures. Companies are starting to assess their exposure to climate risk. And we've seen recently some of the US energy intensives like Chevron and ExxonMobil say we're not facing any near-term risk. Can you speak to how tenable you think that is in the longer term, and whether for energy intensive companies, but also companies more generally, as they start to really grapple in the next year or so with assessing and ultimately disclosing these type of risks?
I think it's going to be, well, I think this comes again back to disclosure. I think it's not easy to say what the exact right practice should be for any given company other than disclosing what they know, disclosing, I guess, sensitivity to different considerations. And I think what we've seen, as I mentioned before, out of Europe is much more constructive. I think in the US, we're gradually getting there. I feel like we're pulling the dog into the vet's office. But effectively, we will get there. And I guess, I'm going to be a little evasive on that because I think it depends on the company, it depends on the circumstances, but we just need the information for us to be able to work with it.
I'd probably reiterate, shout out to Statoil and the idea that short term, sure, we're all going to need oil and fossil fuels. And Matt Arnold did a great job last night, and as Kate had mentioned about that, look, short term, stranded asset, maybe it is a bit of a joke, but long term, look, Statoil has just changed the name. They're thinking about this. They're looking at their long term. What business are they in? They're in the energy business, not the oil business. And so long term, you absolutely have to address those issues. And so that's my thoughts.
So I'll answer from the perspective of an asset manager who does not need to be invested in the entire universe, and so we want to be picking the best companies that we think are going to outperform the general market over the long term. And so, frankly, we would avoid those companies. I mean, we really do think that when you're talking about, especially sort of the U.S. based, but the energy companies where fossil fuels is the core of their business and not a part of their business where they have diversified other parts of their business. It's really the core fundamentally of what the business model is. It's not something that we feel comfortable being invested in over the long term, and we find it to be risky. So I think a lot of these companies are going through analyses and some self-reflection about how much that actually is the core of their business or not. And Statoil is obviously at a forefront of this in terms of transitioning the business. But I think there are a lot of them that are fundamentally in a tough spot. And I think even if they are trying to work their way out of that business model and having different opportunities going on to the future, I mean, at this point, that's where they're deriving most of their revenues from, and that's where they will over the near future. And so it doesn't make a lot of sense for them unless they can be truly long-term oriented to actually change their strategy, and we don't really see that happening. So. By the way, can I chime in just quickly? Yeah. Because I do think there's an interesting point here. If we have different approaches, I mean, we will invest in a fossil fuel company, but we want to engage them on these issues. It's going to be interesting to see how this plays out over the next 5-10 years, because if more investors choose not to own them, effectively you are changing the cost of capital for these companies. And you mentioned Peabody Coal. Yeah. I don't think any of the coal companies survived, right? I mean, basically, we're still using a lot of coal in the US, but almost the entire industry went bankrupt. Yeah. And so it's going to be interesting to see if, I mean, when we've done the analysis, there's no way to avoid using fossil fuels for the foreseeable future. And when we look at it, even if the entire world took a Norwegian approach, again, coincidentally Statoil, but Norway actually has reduced their energy use per capita pretty substantially in the last 5 years. But even if the entire world tried to move in that direction, you're still going to have increasing use of fossil fuels. It's just going to be interesting to see what happens in the financial market to the cost of capital, and then the companies' financial share prices might diverge from the use of the underlying product, is where I'm going to. Yeah, and if the entire world of, I think, sustainable investors chose not to invest in the ExxonMobils of the world, arguably Exxon would be even farther behind from where they are, because it was those who were invested who pushed the shareholder proposal that passed last summer, right, the day before we pulled out of the Paris Agreement, that passed, that requires ExxonMobil now to do climate scenario analysis. So it is an interesting sort of intellectual debate that I hope is happening at business schools like this about ownership and sort of responsibilities of ownership. Well, I mean, you're all raising such important points on this. I would point people, if you haven't looked at this, Bob Litterman, who was at Goldman Sachs for 23 years and is like the grandfather of quant science in the investment world, is on the WWF board and actually ran a parallel strategy where he had a fund that was invested not in any risky fossil fuels. So he specifically called out coal and unconventional oil. The fund divested from coal and unconventional oil and ran it in parallel with sort of their usual fund that the WWF endowment ran, and it did substantially better. You can look at it, his numbers online. So in that case, that's interesting because those two industries, the prices have gone way down. Coal is collapsing essentially, and unconventional oil is much harder to justify because the price of oil is down.
So I think that's important in that you can see some evidence that that there are pieces of this that are in fact maybe not becoming stranded yet because we're still using them, but there's depreciating value of those massive capital investments that have been made. On the other hand, those companies, Statoil is a great example, Total is also a great example of a company that's diversifying. Also, the utilities have made these huge capital investments. They have to continue operating them for the period of time that they exist, or else they're just going to lose. They're not going to abandon all those assets tomorrow, nor are they going to abandon their entire workforce, which is all geologists, basically, and engineers. So it's a very slow ship to turn, these big companies, but it's important. The last thing I wanted to say about it, though, is sort of to Ron's point about kind of you need to watch kind of all the different factors going on in this space. So looking at companies to see what they've got on the books and how they're treating them, what they have on the books, and where they're making new investments is important. But there's also the tricky other side on the fuel side is that as these things get cheaper, we use more of them. Yeah. So if you look at the last 2 years in the United States, our vehicle miles traveled has gone significantly up. For the first time in a long time, we had been plateauing on vehicle miles traveled, which is how you measure how much people drive, basically, right? We're going up again, and big cars are getting sold now again at a much higher level than they have been since before 2008, the financial crisis, and that's because of cheap oil. Yeah. So you get this really interesting feedback loop where we're going to use less of this stuff because companies are starting to diversify and there's all this shareholder pressure, but at the same time, what's that impact of cheap fuel on consumers, which is why we ultimately need a price on
Which is ultimately why we need a price on carbon.
Yeah, that's why we need a price. Exactly. That's the conclusion. Exactly. That's why we need a price on carbon, because the market can only do so much, and then you're going to see those feedback loops that happens with energy efficiency too. That people get more and more efficient, but then they end up using more kilowatt hours. That's right. So this is why ultimately the policy surround is so important.
Just one comment on okay, so you're an investor. How do you actually quantify? Right. How do you pick up a Statoil as behavioral change? Yeah. ESG non-financial factors, and this thing called ESG momentum scores. So let's just look at fossil fuels. Let's look at Statoil and look at BP, not throwing them under the bus. But hang on, BP continues to do what they're doing. Yeah. Fossil fuels, Statoil. Well, hang on, they're starting to see a real behavioral shift in their business model. We're going to pick that up from the quant scores that we're building, both through the likes of a human-driven data provider like an MSCI, or a machine-driven data provider like, in this case, True Value Labs, where they're using machine learning, web scraping techniques to pick up some of these behavioral shifts, just to give you.
That's a great example.
Great. So we're going to keep talking amongst ourselves, but do you want to know, there is a mic back there, so to the extent that folks have questions, we can definitely pepper those in. So just feel free to line up there and chime in. But I wanted to pick up, it's come up a couple of times on the data side, so I want to pick up, Elizabeth, on that, given that you all are focusing specifically on trying to find that advantage by looking at ESG data, at climate data. And could you speak to the challenges, because it's sort of a brave new world in terms of finding and using that data. Can you speak to the challenges of the breadth and quality of the data now and how you see that evolving?
Yeah, so we need better data. I think everybody here agrees on that. We need more timely data. We need more accurate data, and we need more ubiquitous data. So on the timely front, to start there, we are currently using in our investment process 2016 carbon emissions. And so as we learned in this morning's presentation, climate science is changing rapidly, right? The climate affects, the real climate is changing so rapidly. We need more timely information. And a lot of companies actually have more current information. But to be able to sort of compare across a broad data set, the whole group needs to rise and become more timely. But a lot of companies have figured out that it's much easier in their own processes to have individual teams just reporting it real time and having it roll up into a system automatically. And so sometimes when we contact companies, we realize they actually have the most current emissions data, but that's not sort of what the broad data set is representing to us. So more accurate data as well. So talking about increasing the range of data that we have into companies that are not now disclosing it. So that sort of other 25% of the S&P 500, and then well beyond that, into markets in parts of the company supply chains and elsewhere that right now are being estimated, that companies themselves are estimating, and we don't use this data, but many investors do, that are being estimated by the True Cost of the world or the Sustainalytics of the world. There's a lot of estimating going on out there, and a lot of it is not very high quality at all. So we need more accurate data and more ubiquitous, so more around all types of industries. And so one thing that I would highlight as sort of an issue that we've been studying recently at Terra Alpha is related to agriculture and soils. I think you'd mentioned that before, and just that we see this as one of the new waves of information that's going to be really critical for those who are focused on solving the climate crisis issue, but also other issues related to rising populations and strained natural resources, is data around soil and soil health, where there right now are very few standards. But interestingly, food companies and agricultural companies are starting to understand that they need to get a better handle of this if they are going to meet the demands of their future and if they are going to be able to produce the products that they need. In the next 30 years, we are going to require 60% more food to feed the growing population of the world. So that's a totally frightening thought, and the quality of soil overall is declining, and especially in some really strained areas of the world. I guess the final thing that I would say on data too is that there is a lot of talk and interest in the TCFD guidelines and the scenario analysis, and it was sort of discussed last night, and just what an amazing effort the TCFD was, led by Michael Bloomberg and other real financial titans of the world who were worried really about risks to the economic system, so a very different way of looking at the climate issue. We just want to make sure that when these scenarios are being produced by companies, that they're actually usable by investors and by other stakeholders. And I think we have a concern at this point that each company is going to be sort of doing its own scenario analysis with its own assumptions, and they're not going to be comparable at all. And probably for you business school students, a great actually opportunity to start a consulting business where you work to standardize a lot of this. I think there's going to be a lot of opportunity for the PwCs of the world and the other sort of consulting companies who are going to have to help these companies work through this new demand. But for us as investors, we really actually want to understand the underlying data, and we want to be able to compare it across companies. And so we hope that that is what this is ultimately leading to, is more transparent, consistent reporting from companies that investors and other stakeholders can use.
Just a really quick point on the soil point, because that is sort of the frontier of data right now, is soil science, and it's partly because of the food issue, but it's also because of carbon removal. Soils, trees, land-based carbon removal is a big possible piece of the wedge of getting to where we need to get globally. And there's a lot of incredibly interesting research to be done, but the soil science is still not there. So we don't know how much an acre of one crop versus an acre of another crop versus an orchard of a particular kind of tree, how much carbon is removed for how long, and what that cycle looks like. That's something that's an incredibly interesting area that people are working on now, and it's going to be critical.
Great. Any other quick thoughts on data before I see we definitely have some?
Just a quick shout out to the Sustainability Accounting Standards Board is trying to be the framework. I mean, the biggest challenge, how many people speak a foreign language outside of English, right? Or should you say, how do you say that politically correct? Like,
another language.
How do you speak another language outside of your born language, right? So that's the biggest challenge we all face, is everyone's speaking the same language. Mark Carney did a great job with the TCFDs. Now we've got Gene Rogers, the SASB, using this framework we're trying to codify, I think this year, if I'm not mistaken, to be able to get everyone on the same page to this point. So that's a key piece.
Well, just benchmarking. I mean, I hear this more than anything else. There's no benchmark for data right now. So even all the big reinsurance companies are using 5 different consulting firms with different data approaches for how they think about physical climate risk. It's just sort of a mess, which makes sense because it's a business, but it also is, it really, really needs to be standardized, because you're absolutely right. You can't do standardized disclosure without that. The last thing on that, on disclosure, we haven't mentioned it yet. France is the only country that has mandatory disclosure of climate risks. It's Article 173 in France. That is something to watch, because that's sort of where everyone is looking to see, how do you do disclosure, what kind of data are people using, how are companies dealing with that. So it's an interesting test case.
Great. Let's take your question.
Hi, yeah, thanks. My name is Eric Smith. I'm from Duke. I have a question about capital budgeting. Mitigating climate change will force businesses and governments to make new investments in capital, but timing of those matter. The benefits of those investments may be far off into the future, and if we discount those benefits to today, their value gets reduced relative to their costs. And additionally, the costs of clean technology, as we've heard, has been going down over time. So my question is, in your view, could those two issues incentivize some businesses to push off climate mitigation and sort of extend this orderly transition time that Matt talked about last night? Thanks.
That's a good question.
I mean, I'll take a swing at that. I mean, I do think everything you said is accurate, and I guess this is where the economics of a free market come in. In theory, if you have no government intervention to price the externalities, then you basically, what that implies from an economic theory perspective is you're going to wait longer than you should have to begin addressing it. And I think the worry is when you look at some of the curves that start to get a little bit more exponential in terms of shape, do you wait too late? And so in theory, you could end up waiting too long until you start to see such blatant evidence that no one can resist, and then you actually have to do the fire drill of panicking and spending 10 times what you would have spent 3 years earlier. I mean, from a societal perspective, I think at some point we have to recognize the market doesn't always work perfectly. As someone who covered financial stocks in 2008 and 9, I can attest to that. Markets did not work well when it came to securitization. And so, I think we're going to have some kind of government intervention, and, disclosure is a great starting point, but we have to price carbon. I mean, at some point, or figure out, to me, that's the most economically efficient way to address this. But we're going to have to figure out some way for government to get involved in public policy to be used intelligently as opposed to the way it's used now in the United States.
So to me, this also raises a really interesting question of who the owners of these companies are. And ultimately, they're not Terra Alpha. They're not the State Streets of the world. They are the pension funds, the foundations, the endowments, all of us in our retirement accounts. For all those organizations should have a long-term perspective, right? The pension funds need to be able to pay pensioners into the futures for decades. I will need my retirement savings in decades ahead. And so the owners of the capital of this world should ultimately have a long-term perspective and be patient, and should really care less about what the stock of this company is doing 3 months from now. Now, there have been books and articles and everything written about why there is a very short-term focus for a lot of the money that is managed in this world. But ultimately, if we can break down some of those barriers to why there is such short-term thinking in the financial markets and in the ownership structure, the capital structure of companies, I think that's a key thing to do to break down a lot of the sort of short-termism and what's creating a lot of the problems that you're talking about.
I do think there's another aspect to this as well. I'm trying to figure out how to balance this. You don't want to be alarmist, but I think we also need to make sure people understand the potential left-tail optionality of not addressing these issues.
Absolutely.
Right? I mean, anyone who owns a house probably has insurance on their house in case it burns down. Is it likely? No, but if it does burn down and you don't have insurance, it's pretty catastrophic to your financial condition. I mean, we should be thinking about left-tail optionality. And also to zoom out, by the way, we've talked a lot about fossil fuel, and I was glad you brought up agriculture. This crosses every industry. I mean, municipal finance. Do you really want to buy a bond issued by a city that's going to be underwater? I mean, how do you think about where your investments are going? If you think about investing in a property casualty insurance company, if the hurricanes become more severe, what's their cost of capital? So this is so expansive. We need to really think about what could happen if you don't prepare.
Just two really quick things on this. One, capital stock turnover decisions happen all the time. So one thing that the second risk visitors report has, and so does all the deep decarbonization work, if you've seen that, is just like an estimate of all the capital stock turnover timelines. And they happen all the time. I mean, there's all kinds of things, even us in our own lives. You're changing your car, you're changing your furnace. Making those decisions in a smarter way actually does make sense, because those things are going to be around a long time. And there's a certain amount of predictability, particularly on the physical risk side. The regulatory and policy side is harder to predict, but I mean, I just want to emphasize what Ron said about a price, and also say I have had so many conversations with investors and with CEOs who you bring up the price on carbon and they'll sort of say, oh, I'm so glad the young people are getting involved in these policy fights. Or I think that it's great that people are activists. And I just want to emphasize, it is in our interest as people working with markets and in economics to have a price on carbon. And investors and business people need to be involved in this conversation. We need a consistent price that's predictable, or else no one will know what they're doing, and the best companies will be punished for being early actors. So it is not someone else's problem.
And a bunch of the economists who supported this and developed the price on carbon are not 25-year-olds, right? I mean, they're the leaders of modern economic theory,
all of us should
right?
want this to happen, and we need to be focused on it.
Exactly. Let's be clear. We need both, though. We need markets.
We need both.
And we need regulatory oversight. And I'll shout out California AB 32 auction. They do a good job. They learned from all the mistakes in Europe, right? And so they set a price floor on carbon at $10.
Yep.
And now that auction process, they've said that's the floor we've set. We're going to ratchet up the price 5% every year.
Yep.
That's a very robust market right now. Good example of market dynamics, bid ask, supply and demand that can make money with that resource scarcity. With regulatory oversight, that's what's going to work.
That's right.
Let's go to another question.
Sorry, it was a good question. Thanks.
Thank you. Hi, I'm Paige Swafford. I'm a dual degree student here at Duke, and you've actually talked a lot about my question, but I want to pull the thread a little further about the carbon pricing. So yesterday we talked a lot about businesses stepping into a void that's being left by federal policy, but this seems like an area where federal or some sort of state level top-down policy about carbon price is the best way to give a signal to the market. So can you talk about, are there things other than a carbon tax or a carbon market? Are there creative solutions we haven't thought about as a way to signal a price on carbon? And what is the role of the private sector, if it has to come from government, to drive them to make a decision when that seems like a non-starter in our current environment?
I mean, there's all kinds. That's a great question. There's a lot going on in the carbon pricing world right now. So China, for those who don't know, just put out price on carbon, did a cap and trade system for the first time. Was originally going to be much bigger and more mandatory than it is. It's a little bit more voluntary and going slower. That's not surprising. It's a huge economy and a growing economy. But the fact that there's a price signal there is really important. And again, as I said earlier, 40 countries, 20 jurisdictions. Oregon and Washington both just tried to price carbon under the California model to join the California market. Didn't work in Oregon because they had a short legislative session this year of only 35 days. They're going to bring it up again next year, and their process is extremely thoughtful, and the private sector is very involved. Washington's looking at a tax. So there's lots of different approaches. In terms of what isn't a carbon tax or cap and trade system, I would really look at these interesting mechanisms like, again, 45Q is the piece of the tax bill that passed that essentially gives you $35 a ton for doing carbon capture and sequestration on an industrial plant, $50 a ton for doing carbon sequestration sort of outside of the industrial plant context, and then 85, you can get an additional 35 if you do direct air capture. $85 a ton isn't actually enough to get people to do direct air capture yet. It's too low, but it's a really good example of a price that wasn't called a price, right? It's essentially valuing carbon. It's this whole idea of carbon to value. How do we create a value? That's an interesting example. The low carbon fuel standard is an interesting example. Sort of anything that provides an additional incentive for something that's low carbon and gives it a boost in the market or removes carbon is a great example. And those things are happening all over the place. Maryland has, under the Chesapeake Bay program, completely under a water program, they have a $100 an acre incentive for cover cropping in Maryland around the Chesapeake Bay. That is, in fact, a carbon removal strategy. It's just not called that. So it's another example of a price on carbon that's sort of in the market for a specific purpose to a specific set of actors. Those things are happening all over the place, and companies have a huge role to play. I would argue, I do a lot of work in the United States I used to do a lot of federal policy work, not as much right now, but I would argue that in the US in particular, business has a huge role in politics. The business community here is both acting at a very local level, so individual senators and congresspeople have businesses in their region that are job creators and also give them money for their campaigns. They have outsized influence, and investors have influence on companies that they invest in. So there is in fact, a particularly big feedback loop here.
Yeah, so I just have 2 quick points on that. I mean, and there are a lot of nonprofits that are doing some work on this, but bringing greater disclosure to the trade organizations, policies that companies are giving money to. So a bunch of companies that say that they're really pro-climate are actually giving money to like the U.S. Chamber of Commerce and some of these other trade organizations that actually, fight against the carbon tax when asked what their opinion is on it. and so I think just greater disclosure and transparency all around is really important about companies, for companies. The other thing is there are a bunch of companies internally that have carbon taxes now in organizations, and I think some companies are really being innovative and trying to understand how to work that into their system, and also what carbon tax is meaningful. And I think a big reason that some of these companies are doing it is that they want to be seen as progressive. They want to be great workforces for young employees or any employees. And it makes them more efficient. So I worked in an organization where there was a carbon tax, and it made us all way more efficient and frugal about our budgets, and saved a lot of excess unnecessary travel, in my view. And so I think you'll see that sort of from these companies learning by doing themselves, even if not regulated to do so.
I think it's helpful to do a definition, okay, so the objective, how do we start on climate change? We've only talked really about 2 bits, and your question is there a third? First bit being cap and trade, second bit being tax. So we could open this up for debate if you want, Dan. But so cap and trade, here's the cap. We're not going to admit any more to this. Let market dynamics dictate the cost of reducing carbon. Versus a tax, the government says, hang on, you owe us this amount of money, and you know where I'm going with this. Is the government going to use those proceeds towards slowing down climate change? We're going to build new roads. So I'm always a big market cap and trade bias, but if anyone wants to push back on me, I'd love to have that debate.
We're not going to start that argument.
By the way, I was going to say, I think there could be one interesting other tool, because I think so far the challenge of collective action has been a big issue. The U.S. for years said we're not going to do this unless China does it. Well, now China's on board, and the U.S. is not on board in theory from a federal perspective. At some point, the rest of the world should probably put a tariff on anyone who's not going to participate. And basically say, if you're going to have an unfair competitive advantage by not having climate change standards, we will charge you for that. And
that may be where we're going. I mean, China and Europe are very collaborative right now on their approach to pricing, on their cap and trade approach, and there is a lot of evidence that they're going to start taking that kind of an approach, and I think that will be a real wake-up call for the United States.
Yeah. And that would change business perspective pretty
absolutely
quickly.
Will.
No, that's a great point.
Money talks.
I think we have time for one more question, but just to Elizabeth's point on companies who are doing their own carbon pricing, I think it's an interesting example of companies getting out ahead of that, because once there is a carbon tax or a cap and trade, those that have built that in, I think Microsoft is a really good example of that. They'll be ready. They've already had the systems in place to move ahead with that.
By the way, but I think as each of you go into your own company, again, regardless of your role, I would encourage companies to talk about that more. I mean, I think consumers will be more likely to buy a product from a company or buy a service from a company that is a responsible company. So I think companies undervalue the value of doing the right thing.
That's right. Interesting.
So I think we have time for one more question, and then we'll probably have to wrap it.
Hi, thank you. I'm Julie from the Georgetown program, and actually am part-time, so full-time I'm a management consultant with a large firm. And one thing I experience with my clients that I consult to, a lot of whom are government clients, and also internally with the company, is that we're measuring emissions and we publish it, and our government clients are aware of what's coming down the pipeline, the risks, but it's kind of still this so what, where should we be? Okay, I know my water usage, I know my CO2 emissions, what should they be? Now that I know, is there a benchmark that I should be working towards, or how do I know if this is good or bad? Is there I know you were talking about data and benchmarks and how that's one part that is missing. Is there a stakeholder that's counseling companies and agencies on what they should be at, or is that still something that's coming?
I can maybe do a quick stop.
Target thing.
The science-based target initiative is one approach, and it's something that companies are increasingly signing on to, where it's taking a look at what are your emissions, what is the overall goal you're trying to get to, and how does your emissions contribute to that, and therefore how much should you lower it accordingly. And it's a pretty rigorous process, and you can formally do it or just use that approach to take a look at your emissions as well. I think with that we probably have to wrap, but
the only last thing I wanted to say, just an overarching point, which is, yes, the targets are really important, but I just want to encourage everybody to think of this in broader macroeconomic terms. Everyone is talking about automation right now, and what's automation going to do to the economy? Climate change is like that. it's as disruptive, it's as big of a deal, there's as much opportunity, there's as much risk. So we should be getting to that level of conversation where this isn't just about how am I reporting to the CDP every year, but it's about what is this sea change in the macroeconomy going to do to my business and how should I be thinking about it?
Awesome.
Great point.
Great. I think we'll leave it there.
Thank you.
Good. Well, thank you very much for a fantastic panel.